Good day, I'm Nadine Dundin, and today we'll be discussing some of the highlights from the South African budget speech delivered by Minister Enoch Godongwana. Upon preparing for the budget tax policy perspective, the National Treasury had the responsibility to ensure economic growth through increasing the current tax base while ensuring that there's an increase in revenue collection. To unpack all this, today we have Deborah Tickle, our international tax specialist, Leon Newman, our corporate tax specialist, Tulin Koenke, our transfer pricing expert, and Tanya van Schalkwyk, our international tax specialist. So just to go straight into the budget speech, Leon, would you mind just unpacking for us what were some of the key changes that came through from the budget yesterday?
Thanks, Milady. I think the obvious key issue was the announcement that the corporate tax rate will be reduced to 27% from 28% for years of assessment of companies ending on or after the 31st of March 2023. This was actually announced in the budget last year, but it was subject to certain amendments being made which were intended to expand the tax base. So the idea was that the reduction of the corporate tax rate would be neutral. That legislation was put in place in terms of the Taxation Laws Amendment Act of 2021, which was promulgated in January this year, and essentially it involves amendments to Section 23M of the Income Tax Act, which imposes a limitation on deductibility of interest on debt where that interest is not subject to tax in South Africa, as well as a limitation of the uses of assessed losses. So this has now come into effect with the announcement. And I think two issues arising out of that, which come to mind for me, are first of all, in that supporting legislation to expand the tax base on Section 23M, some of the amendments were controversial and attracted quite a lot of commentary from various tax practitioners and professional bodies. Some of those comments were rejected or I feel not considered by Treasury. So I expect that there may be further lobbying around that. The other important issue for me was the effect on deferred tax balances of companies. In terms of the relevant accounting standard, deferred tax balances should be determined using tax rates applicable when the temporary differences are expected to reverse, and those tax rates should either be enacted or what the standard calls substantively enacted. Now, normally in South Africa, when the minister makes an announcement in the national budget speech that the tax rate will be changing, that is regarded as substantively enacted because it's unlikely to change. The complication last year was that the reduction in rate was linked to the measures to broaden the tax base, and we had no details on that at that stage. So corporates would still be reporting their deferred tax balance at the rate of 28% because that reduced rate was not substantively enacted last year. Some further guidance would be required on whether this now means that the reduction in rate has been substantively enacted, because we do have that related legislation in place. But if that is the case, then for financial reporting periods ending after the 22nd of February, the corporates would now be restating their deferred tax balances at a rate of 27%, and for entities which have large deferred tax liabilities, this would be positive because they could then effectively reduce the deferred tax liabilities that they're carrying with a associated uptick in their earnings. So that was what was key for me.
Something that was quite interesting about that, Leon, was the fact, as you mentioned earlier, that the tax rate was reduced on the basis that the interest changes and the assessed loss changes, which I think is quite significant and will affect a lot of companies, were designed to offset the tax rate reduction. However, if one looks at the composition of the tax take for this year versus last year, what we see is that over the years, personal income taxes as a proportion of total tax take has been increasing. But for the first time in some time, we see that slightly reducing, with corporate income tax increasing by just over 1%. So whereas last year they were saying of the total tax take, corporate tax would be 15.6%, this year they're making it 16.8%. And personal income tax has come down effectively by 1%, and VAT's remaining more or less the same. So that's quite an interesting outcome from that, considering that the rate's going down.
Tuli, just as from a transfer pricing perspective, what were there any changes, any key changes in this year's budget speech? And maybe you can also just expand on BEPS Pillar 2, because the minister did mention that since South Africa has signed off on BEPS Pillar 2, that will be coming through also. What does that mean for South Africa? Where does it put us? And maybe also from just a transfer pricing perspective, do you mind expanding on that one?
Yes, thank you, Naledi. Just to start off, an interesting point is that the South African corporate income tax rate at 28%, and indeed the new rate of 27%, is higher than the OECD average for 2021 of 20%. So it makes it less competitive than most OECD countries and also some of its BRICS counterparts. So it's quite an interesting development in terms of what it will do for our investment into the country. And as Leon said, we are expecting that maybe there will be some clawback of the lost 1% revenue in terms of broadening the tax base. And the minister did mention that the government's role is to reduce the incentive for base erosion and profit shifting while ensuring that companies and their stakeholders contribute fairly to tax revenues. And that's exactly what transfer pricing is about. It's about ensuring that profits are earned and taxed in the appropriate jurisdictions. The minister also mentioned a 5 billion rand revenue collected from enforcing activities. We've seen an increase in transfer pricing audit activities. So we can assume that a big portion of that 5 billion comes from transfer pricing just because of the nature of transfer pricing and the amounts that are usually involved. The minister also spoke about the rebuilding of SARS, and last year we did see a media release about SARS working with the South African Institute of Chartered Accountants to upskill various departments within SARS, and transfer pricing was one of them. He spoke about also, as you said, the Pillar 2. So this is a global initiative for a minimum tax regime, and at the moment it's looking to be 15%. Over 100 countries, including South Africa, have already signed up for this minimum tax. In South Africa, the minister spoke about bringing that into the SA legislation. And just a point to note that this applies to companies with a revenue of greater than 750 million euros. And while this only makes up 10% of global companies, it will account for 90% of taxes globally. And also just to include that over the last couple of months, in several announcements by SARS that relate to transfer pricing, and in no particular order, we've seen the inclusion of the associated enterprise definition of Article 9 of the OECD Model Tax Convention. It's being included in the affected transaction definition of Section 31 of the Income Tax Act, which speaks about transfer pricing. And there was also the announcement of establishing an advanced pricing agreement program in South Africa, which will certainly go a long way in bringing some certainty for taxpayers. And also last week, there was the release of the draft interpretation note on the determination of taxable income in relation to intergroup loans. So I think all of this shows that South Africa's tax policy is trying to stay in line with global trends, which I think is a very important point.
Ask you, Tanya, what are your thoughts around the current budget speech in terms of addressing the current inequality rate in South Africa? And is really the introduction of wealth tax, as some politicians want it, really effective? Would it actually achieve its main purpose, which is actually closing the current inequality gap in South Africa?
Thank you, Naledi. Naledi, so it's very important to actually bear in mind that South Africa has numerous forms of wealth taxes already. If we just look at the Estate Duty Act, transfer duty, securities transfer taxes, and then donations taxes as well. There's also been changes in legislation on the taxability of distributions from foreign trusts and so forth. So there is a form of wealth tax in South Africa already. The big thing is also, if we look at global trends, the trend is actually that they are taking away wealth taxes as opposed to actually implementing wealth taxes. But what we have seen in the budget speech coming through is that they want taxpayers to actually disclose the type of assets and wealth. And as that form, they will be able to quantify and see what type of assets they are, and whether it would actually be feasible or whether there would actually be extra wealth that can be generated and what type of wealth tax can be implemented. So it is interesting. So it's kind of against global trends, but yeah, we do already have a form of wealth taxes.
Can I maybe just comment on the fact that, as you say, globally the wealth taxes have been being removed. We saw India, and the lady mentioned earlier, India removing their wealth tax in 2015, France more recently in the last couple of years. But there are huge calls because of the growing inequality due to the pandemic. So there will definitely be a need to address the inequality. And what I saw in the budget was the minister, although he mentioned this need to include this information in the tax return, but emphasizing the need for growth, because inequality essentially can only be reduced by having growth. So the budget was aimed at promoting growth, and let's hope that they achieve it.
One other point that was interesting for me in this regard was, Tony and Deborah have mentioned it, is increased disclosure in the tax returns. And what the proposal is that taxpayers with assets of more than 50 million rand must disclose their assets and liabilities at market value. It's always been at and currently still is at cost. And that is in respect of the budget refers to specified assets and liabilities. Now, we don't know what they are at this stage, but high net worth individuals typically hold a lot of their wealth in the form of unlisted shares. And valuing unlisted shares is a complex exercise. And because taxpayers have to certify the completeness and accuracy of the amounts disclosed in their tax return, and the Tax Administration Act actually has criminal sanctions for making false statements in a return, I think that would be quite a concern for a taxpayer who has unlisted shares and has to state it at market value. There could be a practical difficulty in that they would have to go to the time and cost of independent specialists to excuse me to help them value these shares. So I would welcome the greater transparency, but I think there are some practical difficulties potentially associated with this, depending on the definition of the specified assets and liabilities.
Yeah, I also think it could be quite interesting from the point of view of the implication was that the balance sheet at cost will still be required because they like to do that reconciliation. So now there'll be both, which is obviously a lot more information, as you say, Leon.
What can they be done to help SARS in terms of increasing compliance, making sure that people actually do provide and disclose information? So are there any thoughts on how we can just help SARS in terms of not really help, but give ideas on how SARS can be capacitated to just make sure that they actually improve, their tax collection and revenue collection and compliance from taxpayers, especially more so around high net worth individuals?
So we have seen where they have entered into an agreement with SAICA to actually give their inputs and provide training and upskilling of staff members within SARS. We have also seen the introduction of specific units in SARS that would address the revenue collections, the high net worth unit being one of them. So I think that they are definitely in the right direction, and that people are being upskilled, and that the revenue collections has been increasing, which we have seen over the past year. So I think that that's generally good news for SARS.
I think just on to add to that, in terms of that memorandum of understanding between SAICA and SARS, SARS actually called for applications for contracts for chartered accountants with tax experience. In fact, the criterion was 25 years of experience to work on projects that would narrow the tax gap. As far as I'm aware, that program of work has not actually yet been implemented by SARS, and I certainly think that would further help with the efforts that Tanya mentioned to date in ensuring greater revenue collection and compliance.
I think it's important to note, if one looks at the SARS strategic plan as well, that along with the common reporting standards, which means that SARS receives huge amounts of information about what people have in bank accounts cross-border, they are uplifting or upgrading their digital capability. So the ability to analyze the information they receive, both on individuals from a common reporting standards perspective and also from a corporate perspective, thinking of the transfer pricing truly, their capability is going to be significantly enhanced. So it is going to be important that disclosure, as you say, Leon, is made properly.
Yeah, and I think, Deborah, like you said, in terms of transfer pricing, I mean, we've got South Africa has signed into the multilateral instrument for automatic exchange of country-by-country reports. So I think that's a very important tool in terms of risk assessment for transfer pricing purposes. So, I mean, that came into effect a number of years ago. So I think if SARS can, if they can get the increased capacity, that will allow them to be able to make use of the information that they do have at hand, that will go a long way in assisting.
So together with the reportable arrangements, it's going to be very important that clients of Regan van Roy structure their scenarios properly and carefully in line with the advice, but also making sure that the implementation is done properly.
Thank you, everyone. So just before we go, I just want to, are there any closing remarks from each of our panelists in terms of the budget and what we've discussed today?
So I think that overall the budget addressed some of the key aspects that we were looking at, and that is to actually stimulate economic growth. And like the minister pointed out, that it's not the time now to increase the taxes. And I think that where taxes were actually reduced, like the corporate income tax rate, the necessary provisions were put in place to ensure that there's no base erosion and profit shifting. So overall, I think that the budget speech serviced the country well, and I think it's actually a good speech for where we are currently in the economy.
Yeah, just to add to what Tanya is saying as well, I mean, given where our economy is now, due to the effect of COVID-19, the effect of the civil unrest that we saw last year in the country, I think the minister and his team have done well in terms of just trying to inject some hope back into the country, and hopefully on the spending side as well, there will be follow through in terms of allocating the revenues effectively for service delivery and what the nation needs.
I agree, Tuli. I think they've kind of had more of the same budget, apart from the decrease in the rate, which we were expecting anyway, because it was announced 2 years ago. So more of the same creates certainty, which I think is the one thing we haven't had over the last 2 years. So there is an element, if they can implement, as you said, that's the most important thing. There is an element of something actually remaining not too different, which is actually quite refreshing. I think it's sometimes a positive thing not to do too much.
I agree with my fellow panelists. I think it was the budget has been generally well received.
Right. Thank you so much to our panelists today.